All right, so obviously we're not taking the exam right now. That exam number 1, we're going to do that on Friday. So as a reminder, I'll provide a formula sheet, and one of the problems is going to use Excel. So if you're sitting at a computer that is broken, because some of these are, please be sure that you bring your laptop that day. Otherwise, you're free to use the university machine. The only reminder I'll give you is that when you use Excel in an exam, you have to start from a blank workbook. And so you have to start from scratch. You can't just readapt a homework assignment or a previous in-class exercise to solve the problem. All right. Any questions about the exam? We'll begin it on Friday. Yeah, go ahead.
With the equation sheet, is it going to be like the A over P and a P over A kind of stuff?
Good question. Yeah. So it's going to include the factor equations, and then any other equation that I'm asking you to use on the exam. So for instance, if I give you a question related to effective versus nominal interest, then I'd provide that formula on the formula sheet. Yes?
With the question on the Microsoft Excel, will we have to PDF that and submit both the original and the PDF again?
You'll only submit the Excel file, so you won't have to create a PDF with that exam question that uses Excel.
Okay.
Yes?
Will we be provided with factor tables of any kind?
Yeah.
Thank you.
So if there's a question when I want you to use the factor method, I'll provide the factor tables. And so there may be a question where I tell you you have to use the equation method. And the way that I'd ensure that is I'd give you some interest rate, an odd number interest rate, 4.75. There's no factor table for 4.75. But then another problem, I may ask you to find something based on an interest rate where I did give you a factor table. Any final questions about the exam? Yeah, go ahead.
When we are working in Excel and we have like different problems, do you want us to do all the problems on one sheet, or like switch over to another sheet, do a problem there, and do a problem on the next sheet?
Good question. Ordinarily, I think the best approach would be to have a different sheet for each problem. This one, there's only going to be one problem though, so it'll all be on the one sheet.
Will we have to annotate that worksheet like we would in a homework assignment?
Yes. Yeah. And so his question about annotation is, remember the notes where you're explaining what is in each column, how you calculated a certain thing. You should add the explanation and the signposting that normally would be used. Now, certain things are self-explanatory. If you have a column that says amount, I know what the amount is. If there's a column that is years, I know what the years is. But when there's a column FV of amount, well, what did you mean by that? Just kind of show that even if you make a calculation mistake in typing in the equation, maybe if in the explanation you indicated something that helped me to feel more secure that at least you're headed in the right direction, I can give you a little more partial credit. And so that's why I suggest that you annotate the solution in an exam, is because the more you demonstrate understanding to me, the more points I can give you if the final answer ends up being wrong. Was there any other questions? Yeah.
With the Excel problem, is it going to be like just on the exam, like when we get it, or is it going to be like on Blackboard?
It will be a question that's described on paper. Then you'll start Excel with a blank workbook. You'll do your work. You'll write the final answer on the paper, and then you'll upload the Excel file to Blackboard, similar to submitting an assignment. So it'll be that same kind of upload a file tool that you always get when you're turning in your homework. Any other questions? Okay. On Friday, April 17th, you're going to be turning in the course project. And I want to tell you a little bit about the project today. It's worth 9% of your grade. And so, that's enough that if you didn't do the project, that's probably going to drop you a letter grade. So it's an important part of the course. It's a part where you're applying what you've learned through the semester to the subject that interests you the most. So what subject interests you the most? It's yourself, right? Everybody is most interested in themselves, and that's what this project is all about. So it's due on April 17th, and the idea is, what I want you to do is project through your life what's going to happen with your money. And so, just as an illustration, this is a diagram that's often used in environmental engineering. It's a reactor. And so consider it's like a tank where some sort of a chemical or a biological reaction is occurring. There's an analogy here to finance that I'll get at in just a minute. But for now, assume it's a tank of some liquid where a reaction occurs. Well, things go into the tank, like a flow of constituents is going in. And in the case of finance, what's coming into the tank is your income. And what goes out of the tank are your expenses. Like regular expenses would be things that are recurring on an ordinary basis, like rent, your cell phone bill, car payment, energy cost, groceries, just the things that come around pretty regularly that you have to pay for. And there may also be, over the course of your life and your career, some extraordinary expenses that are one-off, not recurring expenses. You know, for instance, if you spend a lot of money for a big wedding, that might be considered an extraordinary expense. Or having to all of a sudden put down a big chunk of money for a down payment on a house, that would be an extraordinary expense. Or when your kids go to college, you want to have a lot of money in reserve for that. So money comes in, money goes out, and the question is, what's happening to your savings balance over time? And so think about how much liquid is in this tank. If this is liquid and there's flow in and there's flow out, if the liquid level is getting lower, what does that tell you about the balance between in and out? Too much out. If the level is getting lower, that means you're spending more than you're earning. And that's not sustainable over the long term. You know, sometimes you can do it over the short term. Anytime I go on vacation, I'm spending more than I'm earning. You know, especially if you go someplace like Disneyland. Anybody here been to Disney World? Oh man, that place exists to empty your wallet as quickly as possible. And it's not the only place where that's the case. But hopefully, what you have over the long term of your career is that in is bigger than out, and your cumulative savings balance keeps getting higher and higher and higher. Why do you suppose that's important? It's maybe just an arbitrary number on a paper, so why do you care if your savings balance is getting bigger? So you can retire, because there will be a time during your life, hopefully, that you get to stop working and draw down that savings. Start to do things that you enjoy without the pressure of work. So you may decide that you want to travel the country in an RV, or you may want to sit on a beach in the Bahamas, or whatever your interests are, golf. Hopefully you've got enough savings balance so that you can draw down, continuing to spend, but you never run out of money. That's the hope. And so the subtitle of this course project is A Cash Flow Diagram for Your Life. And so think about the cash flow diagrams that we've been looking at so far this semester, where we have income and outflows, and then we'd find the net amount. We want to look at the cumulative savings balance over time, and there's lots of different places that balance can be. You may have a savings account, but it can be other types of accounts as well. Has anybody here ever heard of a 401k? So that's a kind of savings plan that a lot of employers participate in, and it's a tax-advantaged savings account, where the way it works is you put your money into a 401k, and the dollars that you put in aren't going to be taxed at first. And so all of the money I get from Marshall normally would get taxed before I get to spend it. But the amount that Marshall gives me and then I immediately turn around and put into a tax-advantaged savings account similar to a 401k, I don't have to pay tax on that. And so it's more. It's a bigger amount that gets saved. Now later on down the road, when I take the money out, that's when you have to tax it. But the advantage is that it continues to grow tax-free during all of those intervening years. And so some of your savings maybe would be in a savings account, which you could spend at any time, but some of it maybe is in a retirement-specific account. You may have some of your assets tied up in the value of your home. So we want to know over time, how is your savings balance doing? And the nice thing about it is there's a reaction that occurs. The money grows independent of what's coming in and versus what's going out because of interest and the effect of compound interest. And so one of the ways that this amount gets bigger is that wherever you've got it saved, whether it's in some savings account, some stock funds, bonds, real estate investments, certificates of deposit, there's a whole variety of ways that you can invest your assets. You wouldn't want to have all of them in just one place. They're all earning interest, and so the balance grows because of the reaction that occurs inside of that tank. So this is kind of just an illustration of the effect that you're going to be tracking over time. And to know what your cash flow diagram looks like over the course of your life, you have to do some research on what's a reasonable amount that you can expect to earn when you graduate. And so the phases of the project are numbered. I'll give you a handout in a minute that explains this in a lot of detail, and I'll ask you, please read the entire 4-page document in its entirety as soon as possible. It's not due till Friday, April 17th. Somebody here, hopefully not you, somebody here won't read this until Thursday, April 16th. And that person is going to have a miserable night, and then they're going to be miserable thinking about it every day because they're procrastinating. They'll have the psychological burden of knowing it's out there and they haven't done anything yet. And that's just going to be so painful and uncomfortable knowing that you're procrastinating. Procrastinating doesn't feel good. It feels bad. And then they would have put it off, and so they'll have a ton of questions that they won't be able to ask me. They'll be wondering Thursday night at 11:59 p.m., how should I do this? How should I do that? And then they'll make a lot of mistakes and end up getting a bad grade. So don't be that person. Be the person who reads it really soon and starts to get those questions answered early so that there's ample opportunity for you to optimize. So income from work. What you need to do is, maybe you don't know exactly which company you're going to work for, but maybe you already have an inkling, for instance, that you want to work in government. Whether it's maybe the Corps of Engineers, or maybe working for the Department of Environmental Protection, or the Division of Highways. Have a basic idea, and then you can get information about what is the salary like for that type of position by, number one, you could go to their website and look at the job ads that they have, because a lot of those job advertisements will tell you what the salary range is. So that's one source of data. Another source of data would be to talk to people you know. I mean, most people know a recent graduate or someone who's working professionally in engineering that could shed some light on a typical starting salary for a job classification in a certain location. And that's something that's important to mention, is that if your big dream is to work in New York City, then your salary and expenses will be wildly different from someone who decides that their career is going to be here in Huntington, West Virginia. And so I'd like this project to actually be a realistic reflection of what you want to do with your life, what are your values in terms of spending money, what are your goals in accumulating money, what type of actual job would you be happy for? And so make this a reflection of your current situation. Some of you maybe already are working. I've had some students who are already married and have a family, and they're asking me questions like, well, should I combine with my spouse's income in this project? And my answer is, it's up to you, but make it an accurate reflection of what you really plan to do, because this is going to be one of those rare assignments in college where, it's for academic credit, but it's also a chance for you to plan your life, and it could be like this useful evolving document over time where you set goals now, but then you continue to update this spreadsheet you're going to generate with the actual savings balance, and then it can kind of get you an idea of how close you're getting to achieving your goals. So the first thing is gathering data on income from work, and there's websites out there that also can report engineering salary data. Things like, I think Monster.com has some articles about salaries. There's all sorts of job websites out there that aggregate data. Okay, you're also going to need to summarize your expenses. Your expenses now aren't the same as they're going to be later in your life. Once you graduate and have a steady salary, probably you're going to live in a different place than you live now. And maybe you're going to drive a different car. Maybe you're going to spend more on restaurants in 10 years than you do now. So what you need to do in section 2 is consider not only what are the expenses and how much are they, but over the course of your life, from now until, here's the really grim part, I want you to plan until you die. So you got to like predict, all right, I'm 20 now, I'm going to plan this out to age 90. So how are your expenses going to change between now and age 90? You know, maybe during the first 5 years of your career, you're living in an apartment, and then you switch to a house. So now your housing costs and your energy expenses are different. And then, you know, maybe after you retire, you move into the motor home, and so you don't have any kind of rent expenses anymore. You're just paying national park fees or whatever. But this needs to be an accurate accounting, and it should be more than just a single layer. I always am a little bit disappointed when I'm reading through someone's project and they say like their regular expenses are food 150, utilities 100, housing 800. It's just like a bunch of round numbers that aren't based on anything. And so I'm not asking you to set a limit of how much you're going to spend, but I ask you instead to look at what do things actually cost that you plan to consume. And so get some real world data.
For something like that, for real world data, could you use, say, your parents' like current bills and like mortgage payments and stuff?
I think that's a great starting point. You know, that's a good real world data set that you have maybe pretty good access to if your parents are willing to share it. So there's certain things I think it's good to rely on them for, like they can tell you, you know, what's the utility expenses. They can tell you what's the rent. But for food, for instance, I suggest that what you should do is break it down into one more subdivision. You know, think about like what are the food items that you'd purchase? How much on a weekly basis, let's say, would you spend on meat, on vegetables, on bread, milk? So kind of get a little bit more detailed in your cost analysis on things that are more like personal preference. And so I think the parent data would be good for utilities. Parent data would be good for housing costs, assuming that you want to live in the same kind of house that they currently have. But then certain things you're going to personalize, like entertainment expenses or clothing expenses or travel. You know, if you want to have a vacation each year, you know, how much are you going to spend on that and what are you going to specifically do? And so the more detail, the better. Now overall, remember, this is worth 9% of your grade, and so I think it's reasonable to expect you're going to spend a fair amount of work on this project. But I don't think you should spend more than 20 hours. Let's say, I think if you spent more than 20 hours, I'm worried that you're spending too much time on this, maybe at the expense of other things. But if you spent less than 10, I'm worried you may not be able to do it all in less than 10 hours. So I think between 10 and 20 hours is like a good target for how much to allocate for the project. All right, so I appreciate that's a good question. Are there any other questions so far? Things that are popping up into your mind? Yeah.
This might be explained on the paper, but do you want us to like write down like a few paragraphs and include an Excel sheet?
Absolutely. Exactly. You're exactly right. So in your report, the written report that you prepare is going to have numbered sections. And so section 1 of your report is income from work. Now at the end, there's a spreadsheet that you're going to put together, and each column you're going to explain in that section of the report. So in section 1 of the report, you're going to be telling me, you know, how did you assume that you're going to start off at $95,000 a year? Like in my mind, maybe I'm thinking, oh, that seems pretty high. I don't know how you're actually going to make that. but then you explain and justify and tell me like what's the assumptions in the written report. So yes, the report should be kind of backing up and describing what I'm going to see in the spreadsheet component. Go ahead. Another question?
For interest. Say you have a good credit score already, or
Mhm.
say you have savings already. Like what happens? Like what? First off, credit score. What credit score would you use? Like.
Well, I mean, credit score doesn't affect a lot. It affects the rate that you pay on a mortgage. I mean, like I guess maybe also the rate that you pay if you're borrowing money for a car. But credit score doesn't affect the interest rate that you earn on a savings account, and it doesn't affect like your stock portfolio performance. And so, I mean, make it realistic. Let's assume that you're going to not default on any loans, so that you're going to have a good credit score. I'd say just make it a realistic reflection. Like if you already have a low credit score, then assume that you have a low one. But my suggestion is be optimistic. Assume that you're going to do well. Was there a question in the back?
Are you going to show us like an example or?
I am. I'm going to pull one up in just a minute. I'll show you a student's submission from fall semester. Someone who I think did a good job.
Are we going to do it by month or a year?
Ah,
To
good question.
Fluctuate my utilities and stuff. And
Right.
I need to back it up. So like where I previously got my place and put in like the security deposit
Mm-hmm.
and the deposits for utilities and include that, or can I start now? and
Good question.
go forward?
I think my suggestion is that it's easiest to think, for example, of your food expenses on a weekly basis. And so come up with a weekly food budget and then multiply it by 52 to get the annual food budget. It's easiest to think about housing costs maybe on a monthly basis. And so think of what's your monthly rent and then multiply that by 12. So annualize all the expenses, because the spreadsheet that you make is going to have one row for each year. So as for like security deposits and stuff, I think that you'll get that deposit back, and so it's not really money that's been spent. It's money that you have that's just somebody else is holding it for now.
Do I need to pull like information for my 401k and find out exactly, or can I just kind of guesstimate it?
Like how much you have right now?
Yeah, because I can't remember my login.
Oh, I think you should get your login. Let's make it accurate. Yeah, if you already have some savings, let's start it with the precise number. All right. Okay, so there's expenses as section 2, the regular ones that recur on an ordinary basis. Extraordinary expenses, which is those one-off things like the big blowout wedding where you're inviting every relative you ever had, and the expense of having a kid and those sorts of things. And so you need to think through your life and figure out what they're going to be. Now, both of these, regular and extraordinary expenses, need to be indexed to inflation. What do you suppose I mean about that, indexed to inflation?
Things cost a little bit more each year. It's pretty predictable.
Costs are going up and it's predictable. Excellent. So you start with year 1. Year 2, maybe you could say, is going to be, inflation is around 3%. Do some research, find the current best estimate for what inflation is. Next year is going to be 3% more than this year's expenses. And so each year, the expenses are going up because prices are increasing. But then there's also going to be certain years where the expenses jump suddenly. Like, for instance, if there's another person in your household, then it's not just inflation that drives the increase in expenses, but it's also a change in circumstances. So if you assume that suddenly you're moving from Huntington to Hawaii, now you're going to have to totally change all of your expenses because food costs are more, housing costs are more, and so on. So you need to think about how your expenses are going up to inflation and your income is likely to change over time. Number 1, because maybe you'll get promoted at a certain, maybe you can assume you'll have 2 or 3 promotions during your career and it's a certain step up in salary. But there's also cost of living adjustments, which are those incremental increases in salary to try and keep pace with rising costs of goods. And so cost of living adjustment and inflation usually are pretty close together in terms of the regular increase on an annual basis of both those amounts. Because people change their behavior during retirement, your expenses may be different. So you may be spending more or less or on different things. And so I ask you to come up with a separate analysis of your spending trends during retirement. Investment is where you do a little bit of research on what type of places you'd put your savings. Now, it doesn't matter if it's in a 401k or if it's in a just a normal cash investment account, but you're probably going to have some mixture of banks and stocks and bond funds and mutual funds. And so it's too simplistic to just say, well, I'll put it all into a savings account at Chase Bank. That's a little less sophisticated than I'd like you to consider. I'd like you to go into a little more detail on, what people who have a professional career and an engineering salary generally have is, an employer-sponsored retirement account that gets put into a balance of stocks, mutual funds, bonds, real estate investments, and so on. And so do a little bit of research about investment alternatives that you may choose and what kind of a return can you expect from stocks versus bonds. And so do some reading online and find what's a conservative but realistic assumption for a weighted average return. And then cumulative savings balance. In the section of the report, you're going to make a graph that shows the balance going up during your earning years and maybe coming down during retirement when you're spending more than you are earning. And then the last part is a section where you identify the references. So now let me show you a student who did a nice job on theirs, just as a illustration of the spreadsheet. So you'll have your age that you graduate, or you could start now, the year, income amounts, expenses, extraordinary expenses. So you see that these columns are just along with what we've been talking about. Now, the amount that you saved this year is going to be the difference between the income and the expenses. And so, for instance, $37,000 minus $20,000 is where the $17,000 comes from. That's how much new money comes in this year that you're putting into savings. There's also a separate column for the investment yield. That is the interest on last year's balance. So you'll notice in the first year there's no interest because you didn't have any balance yet. But in the second row, in year 2, $935 is the rate of return multiplied by last year's balance of $17,000. So on the second year, the cumulative savings balance is how much money was in the account last year plus how much new money did you put in this year and how much interest was added based on last year's balance. So this is an important point that is probably the most common mistake I see in the project, is people not understanding these last 3 columns. So let me reiterate one more time. Amount saved this year is the difference between income and expenses. And by the way, expenses includes taxes. Tax is an expense. So you need to do a little bit of research on how much is income tax, how much is property tax, how much sales tax will you be paying. So, really, how much money do you have left over in this column? This amount saved this year is the amount that you could save because all of your needs and wants have been satisfied and you have excess money. So using the third row as an example, the $66,951 is last year's amount of the cumulative savings balance plus the new money that came in this year from savings, the difference between in and out, and then the investment yield is the rate of return on the previous year before the row that you're on. So you don't earn interest on the amount you're putting in right now. You earn interest on the whole pot, on the total balance that you had before this year. Any questions so far about the format of this spreadsheet? Let me show you the students' report from last fall. Okay, so you can see here is a section that's talking about the job, who they'd like to work for. They went so far as, this is someone who wants to work in the government, and they talk about the different government pay classifications. It's called GS. GS level 7, GS 9. They looked up an entering engineer and what kind of pay level they're likely to start at, and you can find the federal pay tables online. 47,264. So I mean, that's an exact to the dollar amount that a GS7 step 1 would make. And then assuming that after a few years you jump to a different classification because of improved experience, and so this student is talking about how the salary goes up over time, and you can see that there's references in there. So you notice how it says USA Jobs, 2019. That's a citation for a website. And the website, if I go down here to the references, I don't want the link of the website in the body of the report. I want the name of the owner of the website and the year that you accessed it. And so you can see here that for each one of these web resources that was accessed, it has the title of the page, the date that it was retrieved, and the site. Some of them are articles. Some of them are government websites, Bureau of Labor Statistics, the title of the page. And so if we go back to the way that it was cited in the body text, it's the source and the year inside the parentheses there. So you'll notice that this report is 11 pages long. So that section 1 goes into income, then you can insert tables if you like. Be sure and put the reference of where a table is from. So this is a figure that explains how often people get raises in the federal government, how long you have to be in a certain step till you get the next one. Expenses. Now, he gives some information here, but then notes that the expenses are listed individually in the master budget. I guess if I had one criticism for this student is I would have preferred to see that information in the body text. But let's go to the spreadsheet and find the master budget table, tab. So here's master budget, and you can see that for each column they've got a different expense. So healthcare, taxable income, net income. And so the reason why they did that is they're assuming that they are paying 22% of the income as federal tax. And so they're treating taxes an expense, donations to a church, car insurance, car payment, fuel, maintenance, medicine, food, housing, electric, water, sewer, all the kind of utilities that you could think of, loans, vacation, wedding. So it's pretty detailed. The food, I would have liked to have seen more detail than that. They're saying $330 a month for 12 months. Let's see if in the report he talked about the kind of car he's going to own, food expenses. Okay, potatoes, corn, here we go. Meat, dinner costs $17 a day, chicken, beef, fish. I guess it's got a level of detail there. Okay, so housing costs, moving from place to place across the country, the housing costs may be different. He addresses the income and expenses of having new family members. So, married, having kids, then certain expenses are going to go up by a factor of 3. Okay, the extraordinary expenses are the things that don't come every year, so less frequent kind of one-off costs. So any questions so far as you're seeing this report? Go ahead.
Will we have to account for things like Social Security in our retirement?
I think you should, yeah. And that's a great point that if we go to this tab of the the spreadsheet that I was showing you before. How come I can't zoom in here? Let's see if expenses, income. All right, so this is income from work. You can see it's 140,000, 143, 147, and then it goes down. So you are going to have some income during retirement, the Social Security. So I think it's good to account for that. Although, I mean, if you want to be conservative, you can assume that Social Security is going to go bankrupt and that they won't be paying anything to you, if you want to go for a worst case scenario. Other questions so far? Let me show you this student's figure in the end. Oh, okay, so investment talks about certain specific stocks, the allocation, what percent is going to go into bonds, what percent is going into a CD, and how does that come up with the weighted average rate of return. All right, so this is the student's figure that illustrates savings balance over time. So you can see $1.8 million and then a big drop down. I think this is probably moving to a retirement house, spending a lot. That's like that's $1 million, buying $1 million house. Now this can be an iterative project. You can do the budget, and then if your balance gets up to $100 million and all you've been doing is just having a regular career, that might mean that you've made some rosy predictions, like nobody makes 30% a year on stocks. If you assumed 30% per year every year, then probably you'd need to scale that back. And if you find out that you have reasonable assumptions but a big balance, then spend more. You know, my goal is I want, on my last day that I'm alive, I want it to go across zero and into negative territory. I want to leave a bunch of debts, not a penny for my kids. That's my goal. Is nothing for the heirs, and leave my debtors, leaving the people who I owe money just holding the bag. So I don't know if I'll be able to time that right, but that's my goal anyway. So we'll see.
Andrew Carnegie will be proud of you.
Good, good.
The gospel well.
All right, so let me hand out the description here.